guys, JC Parets here of allstarcharts.com, and welcome to the show. Shout out StockCharts TV for having me on. For you guys new here, what we normally like to do is three things. I always want to leave everyone with a lesson, right? What's a good lesson to take from here? So to make sure that, everyone's getting something out of this. Then obviously, let's talk about the market. Let's talk about the charts, what's going on, what has our attention, and then let's take some questions, right? I think that's probably the best way to do it. That's what I thought. Everybody seemed to agree, and that's what we've been doing every week. So thanks for tuning in. All right, so what's the first lesson? The lesson that we want to go over today that I think is important is something I learned from a guy named Jeff DeGraff many years ago, thank God. And one of the things that he said was that you want to identify what type of market we are in, right? And then based on that environment, we want to choose the tools and strategies to best take advantage of that particular environment, right? What we don't want to do is sort of put together like this plan or like this strategy or system, right? And then force that system upon the market regardless of the environment, right? Do we want to do that? I definitely don't want to do that. A lot of people do that. And that doesn't really make a lot of sense, especially when you look at the math, because there's all different kinds of environments. There are trending ones where markets are trending, right? I think, check the math. I don't know, didn't we just have the best performing like 52-week rate of change like ever or something like that? I think so, right? If not, it was close, which is whatever, not the point. Trending market, go back to 2019, go back to 2017, right? These were uptrending market environments. That's one environment. And then you also have sideways messy environments. I remember 2015 was particularly difficult for trend followers. The Michael Covell sort of thought process, right? Nothing against Michael Covell, but like when a lot of these trend followers that follow that sort of thing, struggle if they can't adapt to non-trending environments, right? And at the same time, you've got the mean reverting community. They love their mean reversions. Every higher high is the head of a Head and Shoulders top, and every extreme, like last time the oscillator got to this, right? You've got those people too, that everything has to be a mean reversion. But I think the wiser approach is to be like, okay, we are in a trending environment. Let's use the indicators and the tools and the strategies that do well in trending environments, like buying the dip, right? VTFD, right? VTFD, right? Buying, if you're into moving averages and crossovers, or buying breakouts out of consolidations tends to work. Like those strategies in trending environments do well. Betting on continued sector rotation, and sort of the leadership, right? Following the leadership. Those are trend following sort of strategies. Now, you've got range-bound environments where it's just a mess. Breakouts fail, breakdowns fail, and you get whipped up. It's a great time to get chopped up. Is how the traders say it, right? You get chopped up because you're just getting whipped around in a range-bound market because you're trying to impose a trend-following sort of strategy into a trendless market, right? Okay, so first identify the environment we're in and then pick the tools and strategies that are best for that environment. To kind of finish this conversation off and get into the charts, think about it like, I always like to say, this is from Bruni, shout out Bruni. He says, we don't want to brush our teeth with a hammer, right? You have a toothbrush for that, right? But if your wife wants you to hang a picture on the wall, you're not going to get your toothpaste and your toothbrush, you're going to get the hammer. So for different environments, for different reasons, we have different tools. And in the market, it's the same thing. Okay, so I hope that was good. All right, let's look at some charts. All right, so this is something that we've been looking at because when the market is doing well, these lines go down. And when the market is doing poorly, these lines tend to go up, right? So if stocks are under pressure, Treasury bonds are going to outperform, tend to, obviously, as we can see here in this chart. Consumer staples also tend to outperform in an environment where stocks are under pressure. Usually see a relative bid in gold, and you're going to probably get a flight to safety and quality in the currency market into yen and out of the Australian dollar. So that Aussie yen's going to roll over. In this case, we flipped that. We're looking at yen Aussie, so it just matches up with all the other lines. And then the first thing that popped up was consumer staples, right? We've been talking about that basically throughout all of March because, or at least for after the first week of March, because consumer staples bottomed on March the 1st on a relative basis. So did utilities, by the way. So you saw that that was the first thing, but bonds kept making new relative lows. Gold kept making new relative lows. Aussie yen was making new highs. So there was just nothing there other than the staples. Now there's other things. Aussie yen is rolling over, right? Failed breakouts over there. Gold is still kind of stuck in the mud. It's not really doing much, but it's not making new lows. And you're getting a little bit of a bid in bonds, which we'll get into in a minute, coming at a logical place. But I want to reiterate that it's on a relative basis. Bonds and consumer staples outperforming stocks, and a little bit of a lack of new low in gold on a relative basis, sort of confirming that. So what are we seeing? We're seeing some defensive rotation, which is characteristic of an environment that stocks are under pressure. And then what else is characteristic of an environment that stocks are under pressure is failed breakouts. Go back. Any bear market, any major market sell-off, go back. You know what you're going to find at the beginning of those? You're going to find a whole slew of failed breakouts. Whipsaws, they call them. Ed Sakota wrote a song about it. And so look it up on YouTube, the Whipsaw song. And I'm going to warn you, it's pretty catchy, so it's going to be stuck in your head all day, and that's why I don't listen to it, because then it gets stuck in my head all day. So just warning you, if you're interested, Ed Sakota and the Whipsaw song. So basically, the point is, if you want to avoid whipsaws, if you want to avoid failed breakouts, you have to stop trading, right? Like if you want to guarantee that you're going to stop striking out, you got to stop taking at bats. It's kind of one of those kind of things. This is just a characteristic of an environment at the beginning of a sell-off or a period of frustration, which I think is what we're in, is really a period of frustration for both buyers and sellers, I might add. And then there's rotation going on underneath the surface. But needless to say, mid caps, small caps, and micro caps all failed and are back below those February lows. So JC, how long is this going to take? What's this? How long is it going to take? The answer is I don't know, but as long as we're below those February highs in mid caps, small caps, and micro caps, you can't have an overly bullish thesis from any sort of tactical perspective. I think we need to acknowledge that at the very best, it is a mess, right? At the very worst, we can get into other things, but at the very best, the market is messy. And this small cap underperformance is happening at a pretty logical place here. Another failed breakout in small caps. Granted, they were stretched, but certainly acting or sort of acknowledging, I should say, all these former levels. This is a very critical level. Resistance back in 2016, support in 2017, support. That broke down, turned into resistance, right? After, as stocks really sold off globally from the peak in 2018 and down to the lows a year ago, we're now back to the scene of the crime and failing and a bearish momentum divergence. This is small caps on a relative basis, MGC representing the mega caps. What else is a great indicator for how long this is going to take? Look at crude oil. Crude oil has been doing well over the past year as well. So you've had correlation there, certainly with risk. And then, there's a reason why we've been looking at 66. Even a year ago when we were looking at crude oil and we're talking about targets, the target was the former high, 66. And here we are. And the market is acknowledging these former highs. See that? Acknowledging those former highs from 2019, 2020. Look at that. See that? So here we are back. And how long is it going to take? I don't know. I think that the risk is, for a lot of investors, is that the frustration lasts longer than most are positioned for. So I think it's important to recognize. So If mid caps, small caps, and micro caps are below the February highs, you have to acknowledge that the market is a mess. It is not a trend follower's dream here. And crude oil below those levels, same exact thing. And then why are we looking at crude oil? There's a lot going on here. Energy stocks are back to that former support. So what do we know about our polarity principles? Is that former support turns into resistance. So this is the first time that energy stocks, I should specify, these are energy stocks, and then this crude oil down below. So here, energy for the first time got back to those former levels, right? Back to the scene of the crime. This is the first attempt, right? And then crude oil just barged through like a Kool-Aid man when it tried to get back above the 2016 lows, which I think further reiterates that eventually energy stocks are going to get through that. Also, the question, notice how I keep asking the same question, how long is it going to take? I don't know, right? I don't know how long it's going to take. Probably more than a day, probably more than a week, months, quarters. I mean, maybe not quarters, months. If I, gun to my head, I mean, again, remember, I obviously have no idea what is going to happen next. But the good news is that nobody else does either. And it's very liberating to acknowledge. And I just want to, this is probably a good time to take the time here. It's incredibly liberating to acknowledge that we don't know what the market is going to do next. I don't know. Whoever you watching, you have no idea what the market is going to do next, right? But here's the good news. No one else does either. I don't know. You don't know. Nobody knows. That's the beauty of this. That's what makes this so awesome, right? We don't know. So we just have to continue to weigh the evidence as it comes in, right? And use our experiences and our understanding of the market dynamics to best identify the market environment that we're in, whether we like it or not. You can't play the cards that you want. You got to play the cards that you're dealt, right? You could pretend you've got pocket aces if you want, but if you got the whip, you're screwed, right? So we have to play the cards that we're dealt. And the beauty of the market is that we're always dealt a new hand of cards. And if you don't like it, you don't have to play. And you don't have to pay the blinds either, which is cool. I guess the blinds are inflation, right? So you got to participate one way or another. All right, you got me there. All right. We talked about how Treasury bonds are getting a relative bid. It's coming at a logical place. Former resistance, breakout a year ago. Remember how bullish bonds we were a year ago? For those of you following along for a while, like the buying of the breakout of bonds, right? Like if people were like, "Oh my God, JC, what a brilliant call that bonds." It's like, was it though? Was it really so brilliant? I mean, we were just buying a breakout. I think they might even call this like a cup and handle or something like that. Like this is classic, right? This is like technical analysis, kindergarten, like the second day, I think they teach you this, right? Like classic. So anyway, forget all that. To further reiterate that how, I don't want to say how easy it was to buy the breakout, but I mean, it was pretty logical and the risk was very well defined. So I would categorize it. I never want to say that it's easy making money because it is not at all. I guess this one, what's probably the best way to explain it? It was very logical. How's that? It was a very logical buying opportunity, right? With a favorable risk versus reward profile. How's that for being politically correct, right? All right. Anyway, that's what it was. And sure enough, we loved it. And our target was hit pretty quickly as stocks got destroyed, right? And it was a 161.8% extension. Again, a very logical level for bonds to stop going up, and they did. It's funny because at the time, we kept bumping up against this level. I was like, hey, we're probably going to break out, the more times you knock on the door. And as it turns out, it did not, right? Which is really interesting. And that was part of the bullish catalyst for stocks. So anyway, we're back down to the scene of the crime. Former resistance. It's turning into support. So I think as long as Treasury bonds are above 113, 114, like if they're in that, if we're above 113, there's a bid. If we're above 114, then it's probably a buy, right? So if we're above 113, I think we have to acknowledge that there is a bid for bonds. So there's a reason why mathematically people are paying the government to let them lend them money. So there has to be a reason for that. And that reason is probably because stocks are under pressure. So they just want their money to be safe. They're willing to pay for money to just sit there in a safe haven, if you will. So I think if you're above 113, you have to acknowledge that that's taking place. If you're above 114, it's a long, right? It's a long. So bigger picture, I think, what we had a meeting earlier today, and it's like, JC, what are the, we're weighing all the evidence, and there's a lot of things that are pointing to this being a structural bull market, right? We have that floor. So like the, JP Morgan above 141, as long as that's the case, like market's not in trouble, bigger picture. The XLF above the 2007 highs, as long as that's the case, how bad could things be, right? Can't be overly dramatic about the whole thing. I think it's really more about recognizing that things are messy. That's really the theme. It's a mess. Caterpillar finding resistance at a pretty logical place here, right? The 161.8% extension of that. Do I think we go higher? Yeah. But we're stuck under this overhead supply. How long is it going to take? Right? Let's see. Let me punch it up right now. Yeah. Listen, it's hanging in there. It's battling these levels, right? It's right there. We start seeing it hold above 227. You want to know something? This consolidation may not last that long, right? Start to see financials breaking out to new highs. You know what? This consolidation might not last that long. But I have a suspicion that most investors are just not positioned for a prolonged period of messy markets. I just don't think they are. If you're interested in these slides, by the way, email info@allstarcharts.com, and then make sure to include the password, because I give a lot of presentations around the world, different countries and stuff like that. So who knows what deck you're going to end up with. If you want this one, email info@allstarcharts.com. Make sure to use the password musical chairs. Password is musical chairs, as the market just, rotates around, frustrating. The passive investors are the ones that get hit the hardest because the indexes don't do much, particularly the mega caps and everything like that. We're getting rotation into consumer staples, into utilities. Communications have been doing well. Maybe money rotates out of the communications into maybe more industrials and financials, and that value trade keeps going, right? So this is the musical chairs. Info@allstarcharts.com, password musical chairs. Another interesting thing that we want to watch is the new low list, because the new 52-week low list is going to be a ghost town for a while, unless like something crazy dramatic happens and the market starts crashing out of nowhere, which there's no evidence that that's happening. But the new 52-week low list is not where we want to be looking right now, right? Speaking of understanding what environment you're in and then hand selecting the tools and strategies that help the best in that particular type of environment, the new 52-week low list right now, like there's nothing going on there, right? There's no reason for you to be pulling that up. I'm not telling you what you should do. What we do, what we think makes the most sense is, breadth deterioration is a process. Stocks just don't show up on the new 52-week high, on the new 52-week low list, or 52-week high list for that matter. The new 52-week low list, it's not going to get there overnight. What you're first going to see is these stocks showing up on the 10-day low list, on the 21-day low list, on the 63-day low list, the 126-day low list, before they ever get to the 52 weeks. And for those of you unaware of these numbers, the reason we're choosing 21 days is that's basically about a month's worth of trading. It's about 21 trading days. 63 days is roughly one quarter. Again, semantics, 62, 64, 63, depending on the quarter and how the calendar falls. But basically, 2163 gets you done 126 on a biannual basis with, approximately 252 trading days in a particular year. So that's what we're looking at. Monthly lows, 10-day lows. We're just looking at, the activity on even the 10-day low list, which is not here. There's nothing going on, right? There's nothing going on. So, what I always like to quote my friend, Mike Hurley. Shout out Mike Hurley. He calls it the first fall day. So the first fall day is when you get that spike in new lows that you haven't seen in years, right? Because mathematically, for the market to fall, you need stocks. You know, if we're entering a bear market, if we're in a bear market, the majority of stocks are falling, right? The 10-day, the 20s, 1-day low list, the 63-day, you're going to see spikes in these, right? There's going to be a lot of stocks falling in that category if we're in a bear market, if the market's under pressure. That's just math, right? We're looking at the internals of the market, and we just haven't seen any spike in the new low lists at all. I want to point you to sort of the, like in the past. So for example, notice how the new low list, we were getting spikes in, for the first time in that we hadn't seen in years. We were getting in 2017 and 2018 in anticipation of a multi-year bear market globally for equities, right? You had that first fall day, that day or that week where you had a spike in these names that you haven't seen in years, right? That's what catches our attention. That's what the signal is to fade the next rally. That's what that is when you get that first fall day, as Mike Hurley likes to call it. So that's what we're looking for, and we haven't gotten that. So that's part of the, financials are above the 2007 highs. And by the way, we're making a bull market checklist as we speak. And we'll be publishing that on the blog. So make sure to check that out. And we'll be following up with that. We think it's really valuable to sort of identify levels, things that we're watching that would either confirm that, yes, in fact, this is just a consolidation within an ongoing uptrend, or the market's in a lot of trouble. The market's in a heap of trouble, boy, and we better get out February of last year, January and February of last year, I should say. Is this that? The evidence is pointing to no, it's not. But I don't know what's going to happen next, so we have to continue to reevaluate, and that's one of the things we're watching. Another interesting dynamic, that this is one of the first things, right? With utilities and staples both bottomed out on a relative basis on March the 1st. So, I don't like to be Mr. Pattern guy, name that pattern show. That's not really for me, but it was hard to ignore this diamond sort of behavior, which is characteristic of a reversal, right? That's why that's why they call it a diamond reversal pattern, right? So it's kind of hard for me to ignore that diamond-esque behavior and the relative strength that we've been seeing, of course, and the bullish momentum divergence. If I added an RSI down here, you'd see a bullish momentum divergence as well. So it's like check, check, check. Call it a diamond, call it whatever you want. It doesn't matter. It's more the implications that I'm interested in. And I was like, well, if we break out of this diamond, if you will, that would be a bullish indicator for this particular chart. So what are the consequences for the overall market? If staples are outperforming, that tends to not happen in an environment that stocks are doing great, right? They're not doing particularly well if staples are the outperformers. So, I think we look at staples, right? So what's the prescription, as my friend Phil Perlman likes to say, right? It's like, great, psychologists always do such a great job at describing the issue or describing the situation, and they do a poor job of a prescription, identifying what we can do to improve or get better or whatever the case may be. I don't really know anything about psychology, but that's what Phil says, is that, Phil likes to focus more on the prescription of the whole thing. So when it comes to the market, we want to apply the exact same thing, right? This is great. This is description. We describe the type of environment. What's the prescription? We talked about bonds, a potential long on the IEF. It's above 114 if that's your bag, if you will. On the staple side, I would filter through stocks that are showing the most relative strength, right? As consumer staples have been underperformers for a while, which are the ones bucking that trend? Consolation brands, invest in booze, baby. Why not? If the market's going down, people are going to be drinking more, right? No, I'm just kidding. It's probably true, but it's probably already being priced into the stock. I like the risk versus reward profile here, because we only want to be long if we're above those 2018 highs. If we're not above those 2018 highs, you can't be long, right? The thesis here is that that Constellation Brands, a bunch of booze, is breaking out of this monster base. That's the bullish case, right? You can't make that case if we're not above those former highs, right? But you can make the case if we're above those former highs for the bulls. So, 336, 236, 237. That's the level. We're above those 2018 highs, by all means. It's the right sector. Because there's going to be winners in a messy environment. There's going to be winners in the market. There's going to be losers too. And there's going to be a lot of messy situations. People are going to get chopped up, as they say. All right. So we've got a few more minutes. Let's take some questions. Let's see. What would it cause? What would it take to cause a much bigger concern for stocks? It's a good question. Credit spreads, for one, is what I would look at. Maybe look at a junk bonds versus Treasury bonds ratio. You start losing those former highs from February, like small caps, mid caps, micro caps did. That would not be characteristic of a strong market environment. You start seeing, some stress in credit would be characteristic of a more volatile environment. Bigger picture. If regional banks, if we lose the former highs in regional banks, that's probably further cause for concern. So you're looking at, you're probably looking at on the KRE, you're looking at $65 on the KRE. Yeah, 64, 65 on the KRE. If you're below that, that's a problem. As far as the bond market, if you see the copper gold ratio, resolve lower instead of higher. I think that would be interesting that the market's not ready for. Communications are one of the more offensive sectors that have bucked the trend and have had resilient relative strength. Facebook in particular, 280. If we're not above 280, you probably have to question that strength moving forward. Google has been consolidating in a very tight range for some time. A lack of upside resolution there can crush communications. So keep that in mind. And that would be another soldier falling, another general falling for the market, as they say. So those are the things that I'm watching, bigger, and that's more tactical. Then from a structural standpoint, financials above those 2007 highs, if that's the case, it's tough to be, this is the XLF at 31. If the XLF is above 31, tough to be overly pessimistic on stocks. And again, guys, if you're interested in these slides, make sure to email info@allstarcharts.com. Make sure to use the password musical chairs. We got another minute. JC, what keeps you bullish? Bigger picture. All right, so what causes more concern? We answered what's going to make me, what keeps me bullish. I'll take that one step further, and what's going to make me even more bullish. If we get new highs out of industrials and financials here, I think that would be interesting. Upside resolution in Google, for sure. I think a downside resolution there could be trouble. If staples start to roll over on a relative basis, and those rates start going up and utilities start rolling over on a relative basis, I think that would be bullish short term. But I think the overwhelming theme here, guys, the overwhelming theme, and I'll finish with this. The overwhelming theme, make sure to email info@allstarcharts.com/password musical chairs for the slides. But I think the overwhelming theme, guys, is that the market's messy. The market's a mess. So what? What it is. Some people don't like it. Some people are not going to believe it because they're not positioned for it. It's messy. It's messy. Keep an eye on that value, getting that rotation into that overgrowth. That continues. So I would keep monitoring that rotation into value. And then just be aware of look around. This is the market we're in. All right, guys. Thank you so much for being here. Again, I'm JC Parets of allstarcharts.com. See you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.